What do I lose if I wait? And what do I lose if I rush? The psychology of timing in investment decisions. One of the most difficult questions investors face is about timing. Markets constantly move, and every decision seems to carry a trade-off. Acting too slowly may mean missing an opportunity, while acting too quickly may lead to costly mistakes. This creates a fundamental dilemma. If I wait, what might I lose? And if I rush, what might I lose? Understanding this trade-off is a key topic in behavioral finance. 1. The risk of waiting. Waiting can sometimes have real costs in financial markets. Opportunity cost. Economists call this opportunity cost. If an investor delays a decision, they may miss potential gains. Examples include delaying investment during a market recovery, staying in cash while assets appreciate, hesitating to buy when prices are favorable. Over long periods, even small delays can affect outcomes because of compound interest. The earlier capital is invested, the longer it can compound. However, opportunity cost does not mean every moment requires action. 2. The risk of rushing. While waiting has costs, rushing can be even more dangerous. Rapid decisions often occur under emotional pressure, especially during volatile markets. Research shows that quick reactions are frequently influenced by FOMO. When investors fear missing an opportunity, they may buy assets after large price increases, follow trends without analysis, abandon long-term strategies. Another psychological factor is overconfidence bias, which leads investors to believe they can time markets accurately. In reality, rushing often results in buying at peaks, selling during panic, frequent trading costs. 3. The timing illusion. Many investors believe success comes from perfect timing. However, research suggests that consistency often matters more than timing precision. A well-known concept in finance is dollar-cost averaging, which reduces the pressure of choosing the perfect moment. This approach recognizes that markets are unpredictable and spreads investment across time. 4. The decision balance. When facing a financial decision, experienced investors often evaluate both sides of the timing trade-off. If I wait, I might lose. Potential gains. Compounding time. Favorable prices. If I rush, I might lose. Rational judgment. Strategic discipline. Capital through emotional mistakes. The goal is not to eliminate risk, but to balance patience with preparedness. 5. A practical pause. Before making an investment decision, a short pause can help clarify motivation. Consider asking, am I waiting because I am uncertain, or because patience is part of my strategy? Am I acting because the opportunity is real, or because I feel pressure to act quickly? Does this decision align with my long-term plan? These questions help separate strategic patience from emotional hesitation. Final insight. In investing, both waiting and rushing carry potential costs. The challenge is not simply choosing speed or patience, but understanding which risk is greater in a specific moment. Sometimes the smartest decision comes from asking, if I wait, what do I lose? And if I rush, what might I lose even more?